answer. So some background on me, as Megan mentioned. I do work for Provide. We're a specialty healthcare lender for doctors of all types, specifically private ownership. So we are not funding things like private equity consolidation. And so I do work with doctors of all type, but realistically, most of my time is spent with veterinarians. It's where I spent the majority of my career. So 16 years with IDEX, Patterson, and Provide. But I went to school for finance, so personally, for me, this is kind of a combination of all things I've done either in school or in my career. So very much appreciate working with veterinarians and helping them get to their ownership goals. And I'd be remiss if I didn't mention, live in Portland. This is my 12-year-old lab, Lucy. She just had her 12th birthday and live in Portland, like I said, with my wife. So I'll start with kind of my stat of the day, because typically when people hear specialty lender for veterinarians, they think this is going to probably cost me more money than just like a general small business bank. And in some cases that is accurate, but not necessarily in the banking world. If we look at businesses with the lowest default rates out there, this is data that came from the Small Business Administration. And I am going to talk about different types of loan products that are available to veterinarians. But across all types of businesses through the SBA, veterinarians are the third least likely profession to default on a loan. So as a veterinarian, you have a lot of good conventional options for you. And in our world, the lower the risk, the lower the return, the lower the rate, right? So just because you hear something like we're in the specialty veterinarian world doesn't necessarily mean that things are going to cost more. In fact, I think generally speaking, versus a small business general lender, I think you'd find that for people in our profession, this will cost, like if you're looking to finance something, it would cost you less than what you're typically used to. I guess unless you're in the world of insurance or funeral homes, there is no more stable business to be in than veterinarian. So I'm going to talk a little bit about Provide briefly, and then I want to touch on some of the trends we saw in 2024. And then once we get into 2025, if I come back, I can hit on some 2025 data too. But I've got some ownership trend just to highlight for current owners. A lot of what I talk about today will be focused on existing practice owners. I think that's probably the bulk of who we have on today. If people do want to talk about things like startups, happy to have those discussions, but those are usually a little more confidential in nature. So at the end, I'll have my cell, my email in there. You can email me, text me if that's something you want to talk about. So Provide, again, focused on the healthcare business. And our whole goal is to help healthcare providers with great technology. So we do things a little bit different than a traditional bank. You can apply for a loan with us on your phone. It should take you 30 to 45 minutes. If you've got your tax returns from Granite Peak or have them handy on your phone, it should be a pretty seamless process that takes 5 to 7 days at most from when you finish an application to when we actually have an approval in your hands. So it's certainly not like a traditional brick and mortar bank. That's not really our model. We try to do things a little bit differently. Experience is our top priority in that we're building products specifically for doctors. That's really the only group that we serve. So we have things like banking products that veterinarians would need, like merchant products, like a credit card that rewards you for the things that veterinarians spend money on, like interest-bearing accounts that are specific to veterinarians. And all of those combined kind of get you to the point. So anyway, specialty banking products for the people we work with, which generally speaking are private practice doctors. If you are an owner, you probably already know some of these benefits, but if you're thinking about ownership or you're thinking about a second office or practice expansion, obviously you've got an investment, you've got an asset that appreciates over time as you grow the practice. You're getting you are getting compensation on things that you don't do regularly, right? Like you're getting production benefits out of technicians and the entire staff versus just you as an associate producing revenue. If part of the ownership plan for next year or the year after is purchasing a practice, adding a second office or a third office, one thing I would call to your attention, we do have the practice marketplace. If you go to getprovide.com, I think it's in the upper right corner, we do have a place where you can say, find a practice. I took a screenshot of this just randomly for New York. There's 22 practices available for New York. You can filter these for collections, counties, cities, states. This is going to be anonymized, so you're not going to be able to see what practice this is specifically, but it'll give you an idea of what's available if you have like expansionary plans in your future. So practice loans, we talked about the data from SBA about default rates and veterinary being one of the lowest out there. There's really two types of loans to think about if you're considering a practice expansion. There's conventional loans, there's SBA loans. And if you're an existing owner, I've worked with some Granite Peak clients before, you may have had an SBA loan or a conventional loan in the past. It's important that you pick a partner that has both, in that SBA loans serve a purpose. I would say to the doctors out here, this is probably not your forever loan. This is probably not a loan that you're going to be in for 25 years. An SBA loan is designed to get you more expansionary in a larger project if that's something you need that a conventional loan can't provide. So think about SBA loans are guided by the Small Business Administration. The US government and the SBA are kind of giving each of the preferred lenders their credit guidelines on what they require with an SBA loan. Provide is a preferred lending partner of the SBA. And so we're all kind of playing by the same set of rules as far as rates and fees, collateral, down payments. We're all going to have that same framework that the SBA gives to us. In the world of conventional loans, the individual lender is setting those guidelines. The individual lender owns 100% of that credit exposure. And if a loan was to default, that individual bank is on the hook for that. Versus a Small Business Administration loan where we're playing by the rules of SBA and we're sharing that exposure with SBA and the private lender. So if we talk about those two products, from a rate perspective, conventional loan typically is going to be a lower rate, typically going to have lower closing costs associated with it, typically going to have less collateral requirements than an SBA loan. If we look at conventional loans from our standpoint, the collateral really is just going to be the business assets. So if you are buying your real estate, the collateral is going to be the real estate. If it's a practice loan, the collateral is going to be the practice. Versus an SBA loan where you may have to pledge personal assets. So my typical guidance when I'm talking to doctors about which option is better for them, it depends on the type of project you're looking at, but also I would say a conventional loan is going to cost you less in the way of rates and fees and collateral if you can get that conventional loan. So typically when I'm advising doctors, I would say, if we can get you a conventional option, great. That's where we want to focus. If we can't, for whatever reason, the SBA does allow us more flexibility in cash flow, more flexibility in credit score, liquidity requirements, etc. And we can go there if we need to, but if we don't have to, we want to kind of play in the conventional world. If you are a doctor that has a Small Business Administration loan and you've had it for a period of 3 to 5 years, it's a good time to think about, can I refinance that? Can I get out of maybe some of the collateral requirements that I have? Can I get a lower rate and save on my cost of debt service? And if that's something someone wants to talk about, please, send me a message. Happy to kind of talk through your specific scenario. Before I go through the different products, I've talked for 15 minutes or so. Do we have any initial questions?
None popped into the chat, but I will get us started with, what about non-veterinary and DVM owners, does everything apply the same? Because they're not really, right? I'm not generating revenue, but I can still own part of the
Yeah,
practice. Do I
good
still
question.
qualify?
So for us at least, conventional loans are not available to non-doctor owners. Now we can do those via SBA, and some states do allow that. Most of the states I cover do not allow non-doctor owners, but I know like Massachusetts is one that does. So if you're in that situation because you're not a primary revenue producer, you're going to be in the world of SBA. It's a good example of like things that we can't do conventionally that we can do via SBA, and that is a good option.
Okay, somebody is asking, piggybacking on, if we have a DVM and non-DVM partner.
Yeah, it's going to depend on the structure, right? So if we have a 50-50 ownership structure, doctor, non-doctor, that's something we could do conventionally.
Okay.
Yep. It's a
Great.
good question.
That's it for now.
All right,
Yep.
awesome. So as far as loan products that are available to veterinarians, some of these you probably have experienced if you're already an owner, right? But hospital acquisition loans, if you're looking to buy a practice, again, you can go to the marketplace and see what's available. Those are typically being underwritten on a 10 or 15-year term. Typically, these are fixed rate products. Startup loans, again, happy to have a private discussion with anyone that's thinking startup. This is also a busy time of year for commercial real estate. Like I know from the Granite Peak side, this is a time when people are thinking about, if I want to own my real estate, I probably want to close on this by the end of the year for tax purposes. So like October, November, December, very busy for existing owner real estate purchases. And then we get to January, and that's when like ownership transitions are happening because we're in the opposite situation, right? Seller wants to not have to pay capital gains until the year following. So this next 3 or 4 months in our world, probably your world as well for Granite Peak, extremely busy, whether you're looking at something for end of year tax purposes like equipment and real estate, or practice transition, in which case we're looking at something usually for January. Another product I would mention, we do have equipment loans. We do have tenant improvement loans for people who want to expand their practices, add footprint, do a remodel, etc. Something that is unique that we have that is a little bit different than probably other lenders you've spoken with. We have an equity out product. So just like a home equity line of credit is available for homeowners, you can tap into that same equity as a practice owner and do things like often what I see is people who want to buy land. They have a practice, they want to buy land, they want to eventually build on that land. They can use the equity in their practice to pull money out to buy the land in cash and secure the land while they go build it later. So kind of a cool product for existing practice owners. Debt refi. So again, if you're an owner that's been in an SBA loan for 3 to 5 years, probably a good time to think about what was that debt for? What are the restrictions around it? Do I have a conventional option at this point where I can get out of some of those collateral requirements, like a home pledge, and maybe save on rates and fees with a conventional option? Ground up construction, also a popular product. We do those on a 25-year term. So if you're thinking about, again, a land purchase and then building on it, we do have 100% financing available for existing doctors where you don't have to inject a down payment to go do a ground up construction for your practice. I'll skip the last couple here because obviously we talked a little about SBA. We are a preferred lending partner of the SBA. I think for a lot of the people today, you already own a practice. So probably SBA as an existing owner is only going to be for a very large project. I think for this group, we're going to be more talking about refinancing out of SBA.
I will just real quick before we move on, there was a follow-up question. A DVM with HB1 and a non-DVM with a green card work on the situation, or does everyone have to be a citizen?
If you have a green card, we can finance a doctor with a green card.
Perfect. Okay, thank you.
Yep.
Good. You know all the answers. I love that.
That so far I've been lucky. So we're a very large lender, I guess, in the veterinary world, which is a small world that we've grown pretty significantly over the past 10 or 15 years. So people usually ask us like, hey, how are people starting ownership, right? Like, what does ownership look like as a doctor? Are people starting practices? Are they buying practices? What types of loans are you doing, right? So this is just a general summary of what 2024 looked like for us. Now, again, we're 10 months into 2024, so happy to update these once we have 2025 data. But for the provide business, again, we've got a conventional product, we've got an SBA product. The majority of the people that we were financing were using a conventional product. You're really not going to be in the world of SBA unless you need several $1,000,000 for your project, right? So there are those people out there and there are those projects out there, but for the most part, we're, 80 to 85% conventional funded. And then how people are starting practices, I just think this is interesting data, right? Like there was a lot of startup momentum over the last couple years, but still, generally speaking, over half the people, for us at least, 57% are becoming owners via an acquisition. And I feel like with valuations and practices coming down slightly, consolidators are kind of pulling back on what they will buy. I think we're going to have more momentum in the acquisition business going forward. When we were in the COVID era and rates were very, very low, there was a ton of demand. There was a lot of pet adoption going on. The reality was you could start a practice in most places and be very, very successful. I think now people are looking at in an economy that is a little softer than what it's been over the past few years. Maybe it makes sense to own via additional cash flow versus starting something from scratch. And so we've seen a little more momentum in the acquisition world for 2025. And I guess I would also say, like on the startup side, there are a ton more resources than what we've had in the past, right? Like there's Facebook groups, there's Instagram, there's a lot of social media out there where you can go and get support from people that you don't even know that have done this. In some cases, some of these people have experience and have hundreds of people they can reach out to that have done this exact same thing. And so I think that has created some confidence around starting from scratch. So let's kind of fast forward to you've decided you need a practice loan for something, right? You want to do a footprint expansion, you want to own your real estate. The questions I usually get when I'm first talking with owners is how much do I need? What's the process? How long does it take? Right. And so for us at least, the first call that I have with doctors, I'm not in credit. I don't make credit decisions. My job is to understand your practice, your financials, your project, and try to put some budget around it to figure out what exactly you need. And so we would talk about things like what are the current revenues? What's the current profitability of the practice? How much square footage do you need to add? And just generally speaking in your market, what do I see for build costs on a cost per square foot? So we can start to put numbers around your request. And then we can start to think about things like how long have you owned your practice? What is the revenue? How many doctors do you have? Are you a general practitioner? Is this a specialty practice? If you're the owner, how many days a week do you work? Um, and then what is the owner production and how does the production across the practice vary by doctor if you have multiple doctors? All of these things are important because they all go into the cash flow of your request, right? So as an example, if you are a doctor who owns a practice and you're thinking about a second practice and you produce 800 to $1,000,000 a year, we know that that's pretty healthy revenue production. We know that if you go buy a second practice and you're going to work at that practice, pretty good chance that production is going to be similar or higher. And so we use that production into our cash flow analysis. So what I would say is if you're an associate and thinking about practice ownership, whether it's a startup or an acquisition, knowing your production, really important because that is the data we're going to use for you as a future owner, because that's the historical data we have for you as a doctor. So when we are talking about a loan, we're going to ask about things like, what does income look like? What do your expenses look like? How much have you saved? What are the assets? What are your debts? Um, all of that's really important. Are you a person who saves more than you make? Um, another important consideration, right? A lot of people come to us and say, I have a ton of student loan debt. I think that's going to be a problem for me to expand this practice. I've got a practice, it's grown a ton, but I have $400,000 in student debt. What I would say is we would not look at student debt as a bad debt. In fact, it's the opposite. I mean, if you don't have student debt, that's great. That's awesome. It's always good to have less debt. But if you are worried that your student debt is going to be impactful to a loan decision, what I would say is I don't think I've ever had a loan declined purely because of student debt. We are much more focused on good debts versus bad debts. We assume everyone has student debt. We assume everyone has rent or a mortgage. We assume everyone has a car payment. And if you don't have those things, even better, right? But like those are the things we come assuming. Uh, the bad debts really are more like credit card debt. If you have a lot of high interest debt, personal loans, those are the things that we would look at as if you're a doctor thinking about expanding a practice, we want to clean up all those bad debts as much as we can, right? Like credit cards are great to use as an owner to maximize rewards. And we have those credit cards. We we want you to use them and get the rewards, but we don't want you to carry that debt over month to month. The rates on that type of debt are very expensive, right? And it says to an underwriter, you are spending more than you are making, right? And so for them, that's kind of a red flag. So when we're going through the loan process, these are kind of generally known as the 5 C's of credit, right? Like when you fill out an application, you're having a call with an underwriter, they are the ones making a credit decision. And these are human beings, right? Like we are not just looking at a spreadsheet and saying, hey, the numbers work, it's yes. No, the numbers don't work, it's no. There's definitely an art to this business. And really what they're looking at are these 5 things. It's character, right? Like, do you have a good credit score? Do you have, what type of debt levels do you have? Do you have licensure issues previously with your state? That just speaks to the character of you as a borrower of debt, but also as a veterinarian. Uh, capacity. So business debt. Do you have a lot of debt per the revenue of your practice, or do you have a very small amount of debt versus the revenue of your practice? Is the practice growing? Is it shrinking? And how does that debt impact the new business, right? Because when we do a cash flow analysis for your request, we're going to think about those trends and project them forward. So if you have a practice where revenues are declining, future trend is that they will keep declining, which is, makes the cash flow more difficult. Capital. So really, this is cash. So how much do you have saved personally? How much does the business have saved? Our general rule, and I'm going to go through some details here in a minute, but our general rule is we want to see that a practice owner has at least a month of operating expenses in their business account, right? So they have the liquidity there to cover the next month of operating expenses. For us, that's around 70% of revenue. And I've got an example coming up in some future slides, but generally speaking, we would say if we take your monthly revenue and we multiply it by 70%, that's about what your monthly operating expenses would be. And when I say monthly operating, I mean things like rent, utilities, payroll, supplies, like the general things that you would go through from month to month. The fourth bullet, collateral. So what's actually being pledged for this loan? If it's a conventional loan, we talked about this before, we're talking about business assets. If we're in the world of SBA, different ballgame. You might have to pledge personal assets. If you have substantial home equity, the SBA will require that you pledge a second position on the home with that lender. Again, that's an SBA rule. And then conditions are like, what is the purpose of the loan and how are we verifying the information you have in the application? I spend a lot of time going through the conditions of a loan and what you're agreeing to, and making sure that these are things that are actually doable for you, right? Like when we're talking about real estate or a startup and there's a rent amount in there, does that rent actually work for the space you're looking for? If the condition is the rent is going to be $5,000 a month, but you know the rent for the space you're looking at is $8,000 a month, that's really not a functional approval that you can work with because you can't meet those conditions. And so looking at kind of the totality of it hopefully gives you an idea of how an underwriter would look at a loan request. So if you're thinking about, I'm thinking about a loan maybe 6 to 12 months out, what can I do to put myself in the best position? Get the best terms, get the best interest rates. Again, minimize the bad debts. And I will reiterate, student loans are not one of them. Most people have student loan debt, and most of them are at very low interest rates. If you have a lot of student debt, I would not concern yourself with that necessarily. What I'd rather see is someone with a lot of student debt and no bad debts than the opposite, right? Like that credit card debt, those personal loans, that high interest debt really is worse than having a much larger amount of student debt. You want to have a savings safety net. So whether it's in the personal accounts or in the business accounts, at minimum, we want to make sure you have 5 to 7% of your loan amount stashed away, right? For things that come up that you do not expect. You've got a leaky roof, you've got a plumbing issue, and all of a sudden you're moving into a new space and you've got a much larger debt payment and you've got to go replace a roof. Like we want to make sure that you have that savings buffer. And also we want to make sure that you are someone that saves more than you make. So again, back to like living within the means of the income that you generate as a practice owner. So again, for us, that's a 70% of monthly revenue. That's probably the easiest way to think about it. That is not an exact number. Every practice is different. It's an estimate. If you're at 68%, this is not like something you should concern yourself with. Just generally speaking, we run basic benchmarks and say, okay, on average, it's around 70%. And then I would say know your basic financials. Again, understand your revenue, understand your profitability, know the debts that you have out there, and know both your production and your production across the staff if you have multiple doctors. And then finally, the last step in the process with a credit request is getting on a 20-30 minute phone call with an underwriter. And if you're confident in your plan, whatever that plan is, they're going to sense that. So if you've done your homework on the demographics, you know you want to relocate the practice down the street, you know it's a better neighborhood, you've done your homework, you know it's a better space, show that to the underwriter, because that confidence really, like if you're confident in the plan, the underwriter is going to be confident in approving that plan. Questions? I'm going to move on to the next slide, but Megan, I didn't see if anything
No,
else.
you're good. Nothing's popped up yet.
Okay, cool. Um, I'm going to touch on kind of the two most common reasons that I see that people don't get loans approved. And there's a lot on this slide, but I put it here because I'm going to eventually share these slides with you and I wanted the numbers to be there. So if you're an owner, you can think about, hey, like, am I in this situation or am I going to be okay? Personal business liquidity, again, so back to this 5 to 7%. That amount does vary by the type of loan and by how long you've been an owner, right? So if you've been an owner for 10, 15 years, it would be expected that you would have more than that 5 to 7% savings. But at a minimum, we want to make sure you've got a little bit of that safety net there. So in this situation, I put these numbers here so you can think about if you are thinking about a practice expansion loan, and let's say you're going to add 1,500 square feet to add on a couple exam rooms for the practice. And it's going to be a $500,000 expansion. You've got quotes from a builder, an architect, you know, like this is like a $500,000 type of project. We want to think about what are the debts you have out there. So in this case, my example, you've got a $100,000 monthly revenue, right? So you're a $1.2 million practice. You're requesting $500,000 for a practice loan. You've got business cash currently of 50,000, and you've got $10,000 of existing business credit card debt, right? So again, the math is $100,000 times 70%. We would expect typically those balances would be around $70,000, right? And in this case, you have 50. So you're a little bit under that, and you've got the credit card debt. So if we have credit card debt, those are outstanding balances that we would need to net out. So you've got $20,000 you're $20,000 under the 70%, and you've got the $10,000 in credit card debt. That nets to -30. And I'm sorry, because the window over there's blocking out my numbers. And let's say on top of that, you have $50,000 on the personal side saved. So again, you've got some business savings, you've got some personal savings. This is like the typical scenario that I run through. And you've got $5,000 in personal credit card debt. So again, we net that to 45 and say, okay, you're plus 45 on the personal side, you're minus 30 on the business side, your net positive is 15,000 or 3%. So below the 5 to 7%, right? And so when I'm talking with doctors, a lot of times I'll kind of run through this and they'll say, yeah, I've got the business cash saved that I need, but they don't factor in the existing debts that are out there, right? So like that credit card debt, if you put supplies on those credit cards, we are going to net that back. So you want to think about, what do my monthly bills look like? And do I have that type of balance available? And then what do I have saved personally on top of that? And then what are those personal debts? And then think about what that net looks like. So for the group here, hopefully this makes sense. I do this every day. Veterinarians probably don't think about it this way every day. So if there are questions, please let me know, but I will provide this slide just so you can think about it. But this is like a standard type of request that I would get. And so for us, that's below the 5 to 7% of the loan amount, right? Like, but if we're talking with a doctor, they might say, hey, I've got that loan amount in business cash, but you have to think about the outstanding debts that are there too. Questions? Okay, move on to the next one. The other reason that I run into a lot for practice investments is cash flow. Like liquidity and cash flow are probably the two most common reasons we can't finance a loan. You do not need to be a cash flow expert if you're a veterinarian. These are the things that a lender would do for you, but think about cash flow as the money I'm taking in and the money that's going out. And so when we look at a loan request, so again, back to this $500,000 project request, we would think about, okay, if there's a request for $500,000 for practice expansion, what is the expansionary revenue that would come from that $500,000? And then what does that debt cost you on a monthly basis? And is that going to be better than a break even, right? So think about cash flow as a ratio. We want to make sure, again, we give you a buffer. So the ratio of 1, if we talk about revenue and expenses over your debts, 1 is a break even. 1 means you can make the payments, but that's it. There's no money left over as a buffer for this investment. We want to make sure that that investment, that loan, is going to produce more revenue for you than it costs you, right? Like that's the whole reason you would be expanding the business, is to generate revenue, but not to generate revenue just that debt service would eat up, but to generate revenue that's going to be positive to your bottom line. And so generally speaking, most lenders in our world are going to put a 20 to 25% buffer in there. So again, back to like default rates. The reason the default rate in our business is so low is because when you get approved for a loan like this, it's because you have this safety net in place. You have the liquidity balances. And we know that this is an investment that is going to generate more revenue than that debt is going to cost you. And so from our perspective, the default rates in our business are like 1/10 of 1%, extremely low much lower than even a small business administration loan. So again, if we go to talking about being confident in your plan, if you go through this exercise and you get approved for a loan, I will tell you that 99.9% of the time, you will not default on that loan. It will be a good investment for your practice because we've done things like making sure you have the proper savings in place, making sure that the cash flow ratio and the debt service works for that investment so that you can be confident in the plan. And then lastly, I would just say, generally speaking, whether it's a loan from us or really any lender kind of in the practice space, there's things to think about, right? Again, conditions. If we have an approval for you, I'm going to be going through all of the conditions of that loan. And you want to make sure that these are achievable for you. It's one thing to put an approval in front of someone with an interest rate and a funding amount, but if you can't meet the conditions of that loan, it's really not an approval that you can work with. So reviewing the conditions and what you're signing up for is important. Again, we talked about collateral. So what are you pledging for that loan? Is it just the business assets? Is it personal assets? There are conventional lenders out there that might want personal assets. And so the collateral pledge is an important consideration. Interest rate, also part of the equation. What does this cost you in debt service, right? Like term structure. Is this the right amount of time for you? Like, is this a payment that's comfortable for you? Can you pay down the debt faster? If it's a 15-year loan, can you pay it off in 5 years without a penalty? Can you make principal payments without a penalty? These are all important considerations. Is there a prepayment penalty if you pay the loan off in full? I kind of put these, in my opinion at least, in order of most important to least important. A lot of people would say, I'm looking at the interest rate. That is definitely an important part of consideration. But again, if you have conditions you can't meet and you have to pledge a bunch of collateral on the personal side and you're not comfortable with that, the interest rate doesn't really matter, right? Like it's not an approval that you can work with. So interest rate's certainly high up on the list, but I would say that, probably not the most important. And then I guess lastly, whatever the plan is, I do think it's important to have like a specialty team around you that understands your business, right? We're on here because of Granite Peak. You want to have a veterinary specialty accountant advisor. I think that's super important. You want to have people that have built practices and designed practices before. Attorneys that are vet specific, hugely important. If you're talking about like purchasing a practice, you want to have people that understand this specific to our world. Insurance, again, there's a whole group of insurance people that are out there that work strictly with doctors. I think they are a great asset. And then valuations, if you're thinking about a business and bringing on an associate for a buy-in, or you're thinking about buying a second office, getting a valuation done by someone in our industry, also extremely important. Because we do have a whole world of people, and like I said before, general small business lenders, insurance, etc., are great, but given this business and the stability for it, you've got a team of people that do this with veterinarians all day, every day. And then lastly, this is more just as kind of a leave behind, but when we're looking at the financials of a business, these are some of the benchmarks we consider as kind of our norms. And again, this does not mean that if you're not hitting these benchmarks, that you're not going to get approved for a loan. By no means. But these are just general benchmarks that we look at. So things like cost of goods sold, total expenses, rents, wages, payroll. Everyone's got their own benchmarks. I think probably Granite Peak does as well. They're probably close to this. This is not the perfect number for everyone based on size of practice, corporate, private, etc. But this is kind of a general framework where we start. And if you're an underwriter and your rent is 20% of revenue, that's going to be a question that they'll ask during that credit call is, hey, the rent looks like it's out of line for your revenue. Can you just speak to me about the current lease situation and how we got to this point, right? So these are things that, again, if you're not meeting all these, are not a problem. These are just things that would trigger a question from an underwriter. And then lastly, this is my cell, this is my email. Happy to have individual conversations with anyone that has a project on their mind for ownership, whether it be first practice, second practice, expansion, etc. So 12:45, we got 15 minutes left. I know a lot of people are on lunch break. Are there any questions from the group?
Don't be shy. Now's your time. I will say I really appreciated that you gave us specifics, right? Because so many people talk in like vague general terms that are not relatable. So I really appreciate the numbers and the examples that you gave us.
Yeah, you're
That's
welcome. I'm curious from the Granite Peak side, I guess. The benchmarks that I put up, somewhat in line with
Yeah,
how you think about things. Good,
yeah. That's usually where we're at.
awesome. Well, if there's no other questions, I appreciate the time. Everyone enjoy the weekend, and thank you.
That was great. Let me just some housekeeping. If you need a CE certificate for today, please email events@granitepeakcpa.com. We'll send it your way. Next month's webinar is 12/12/25. It's our last of 2025, which is crazy to think about. Anthony Mahon will be talking to us about the legal do's and don'ts of owning a veterinary practice. And then, as always, this will be up on our YouTube channel. We've got the private Facebook page, if anybody's not on that yet, the Veterinary Ledger podcast. So you guys can keep in touch with us all the time, anywhere. I'm always appreciative of those of you who join us and tune in. So thank you, Daron. I think this was great for me. I hope it was for everyone else too.
Awesome.
Thank
Thank
you.
you. Take
Bye-bye.
care.